Recessionary fears have officially returned to financial markets as the Bank of Japan just announced its first interest rate hike in over 8 years. What's going on, guys? It's CryptoDave here at Top Tier Signals, and in this video, I want to address the increasing likelihood of an economic recession here in the United States, as well as other parts of the globe. And even if you're not here in the United States, it's going to be very important to watch this video, as the United States economy has a huge effect on other economies around the globe, as well as financial markets such as forex, stocks, and even crypto. And guys, if you've been struggling to trade these wild economic narratives, you can join our premium Discord right now and get access to over 20 premier analysts across forex, stocks, and crypto, so you can place some profitable trades while you learn how to develop these strategies for yourself. But without any further ado, let's go ahead and kick off the conversation. So if you remember in 2022, we had recessionary narratives circulating around the globe. The United States had just set in a 9.1% CPI reading in June of 2022, and financial markets were simply in a free fall state. Ultimately, though, the recession never came, and markets were able to recover greatly, entering into some fresh new bull markets that have already made a ton of returns for investors. And this is really due to two reasons. The first is pretty simple. At a certain point, assets are just too cheap or too expensive. It doesn't really matter the narrative or any of the noise that's surrounding them. A cheap asset is a cheap asset. We saw this with Meta, Nvidia, Google, a lot of other major US tech stocks, as well as the entirety of the crypto market. At a certain point, these assets were simply way too cheap for their own good. Now, the second reason that markets were able to recover so well has to do with the dual mandate set by the Fed. The dual mandate basically has two parts: stable pricing for consumer goods and services, as well as a fair and competitive labor market that supports low unemployment. So even though the Fed was raising interest rates very steeply, our year-over-year readings continued to come down, and the unemployment rate remained below 4%, meaning that the dual mandate was still effectively in place and that a recession was being avoided, at least temporarily. Beyond this economic relief, we also saw major narratives such as the AI narrative, the Bitcoin ETF narrative, take over financial markets and spur up a lot of bullish price action. And before you knew it, people forgot what the word recession even meant. Nobody was even thinking about it until now. So why now all of a sudden are people fearful of a recession? Well, it has to do, first of all, with the Bank of Japan raising interest rates for the first time since 2016. Now, you may or may not be familiar with what's known as the Japanese carry trade, and I'm going to explain it to you very simply. Essentially, over the past 8 years, the effective interest rate for the Bank of Japan was near 0%, meaning that you could borrow large sums of Japanese yen from the Bank of Japan, and you would really not accrue a whole lot of interest at all. You'd be able to go take this Japanese yen, you'd be able to invest it into stocks, crypto, other assets that have performed very well over the past 8 years. You'd be able to pay back the Japanese yen that you borrowed very easily, and people were printing money off of this carry trade method. The problem here is that now the Bank of Japan has set a course for rate hiking in order to strengthen the Japanese yen, which basically makes the carry trade a lot more difficult to pull off. It's one thing to do it at 0% or even a 0.25% interest rate, but what happens if interest rates continue to go higher? All of a sudden, the cost to borrow that Japanese yen becomes more expensive, and it's less desirable to have that type of stimulus simply from borrowing Japanese yen and using it to invest. Now, a lot of the initial turmoil was subsided as the Bank of Japan's deputy came out and said that they would not raise rates if financial markets were in trouble. Fast forward a couple of days later, and the conversation notes from the policymakers come back to reflect that they have a strategy to continue raising interest rates. Are they going to raise rates? Are they not going to raise rates? It's really anybody's guess. But beyond this, I want to transition over to the United States, as the United States economy is a huge player around the globe, and there are a couple key metrics that we need to consider here when it comes to an upcoming recession. The first thing I want to focus on is our unemployment rate, which recently saw an uptick in July to 4.3%. And we can look back in history and we can see a very clear and consistent pattern with the unemployment rate and its recessions. The pattern here is pretty simple. You have a period of time where the unemployment rate is coming down and eventually reaches some pretty low numbers. You kind of get this rounded out bottom formation before unemployment starts to tick back upwards. This is generally when the recessions start. We can see this all the way back in the 1950s, a couple of different times, once again here in the 1960s, again here in the 70s, a couple of different times in the 80s, here in the 80s once more going into 1990, here going into the dot-com bubble, and then once more going into our global financial crisis in 2008. We saw the unemployment rate coming down in a sustainable way before eventually bottoming and turning its course. And this is exactly what we see now. Unemployment skyrocketed during COVID and essentially came back down as fast as it went back up. And we can see here that in 2021, 2022, and 2023, we were able to sustain very low and decreasing unemployment. Now we look back into recent history and we are seeing that the unemployment rate once again is starting to tick higher after a few consecutive readings of greater unemployment. Now it might be a little bit too early to tell, but if we continue to get a couple consecutive months of unfavorable employment situation reports, this could be a telltale sign that we are in the beginning stages of a new recession. Now let's move over to the federal funds effective rate, which is essentially the interest rate that the Fed sets for banks to borrow money from other banks. This is the baseline interest rate in the United States. It's what your mortgage rate is based off of, your car loan, your credit cards, all of that stuff is going to be rooted in the federal funds effective rate. Now, it's a common misconception that when the Fed is raising interest rates, that a recession is likely. But it's actually when the Fed starts to cut those rates and begin those rate cutting cycles that a recession actually comes. Once again, we can look as far back to the 1950s to see this pattern. We have steadily increasing interest rates, and then we have a rate cutting cycle at the beginning of a recession. Once more, leading up to 1960, we have the exact same thing. We have about a decade of rising interest rates minus a quick little blurb here. And by the time the Fed is actually ready to cut interest rates significantly, we have entered into a recession that persists essentially through the entire rate cutting cycle. We can see this once again in the 70s, once again in the 70s leading up to the 1980s. We can see this here in the dot-com bubble. We can see it with the global financial crisis. And we can see it here now that the Fed has raised interest rates substantially. That rate has flatlined, and they are now discussing potential rate cuts as early as September of this year. Historically speaking, this is a very key indicator that we could be entering into a recession. If we look over at the CME Group data, which is a predictive market that tries to understand what the Fed is going to do next, we can see that they have a 100% probability currently that the Fed is going to cut rates come September of 2024 with a greater than 50% chance that it will be a 50 basis point cut, not just a 25 basis point cut. So it's very clear that the Fed is gearing up for a new rate cutting cycle, which historically speaking has been very bearish during these types of conditions. A similar data point to the federal funds effective rate is this 10-year minus 2-year Treasury yield. This is taking the 10-year yield of Treasury notes and subtracting the 2-year yield of Treasury notes. And essentially, when you have a yield curve inversion, meaning that the difference is a negative number, this means that short-term yields are higher than long-term yields. And this is because the Fed is trying to encourage a restrictive and tight monetary policy. They are trying to encourage people to stay in cash, hoard cash, and make that cash more valuable to slow the demand for other goods, services, and assets within the space. We can see here every single time that we have had a substantial yield curve inversion, on the upswing of that yield curve, when the yield curve is finally normalizing, which again happens during rate cutting cycles, we tend to see these recessions kick off. We can see it here in the late 1980s. We had a yield curve inversion, we eventually normalized, and this became the start of a new recession. Same thing here with the dot-com bubble. In the late 90s, we had a peak yield curve inversion, we started to round out, we normalized the yield curve, and then a recession came. Once again with the great financial crisis in 2008, we saw a peak yield curve inversion. We saw it bottom out, we saw it normalize, and then the recession followed. So here we are back in 2022, 2023 with the inverted yield curve peaking, and now we are normalizing once more, and we are very, very close to flipping positive on the yield curve, which would be a normalization, which historically speaking has led to a recession every single time. Now, the last thing I want to say is that I'm not trying to instill fear or panic into anybody. We really don't know what's going to happen, and even the best economist in the world, which I'm certainly not, has no idea what's going to happen next or when it's going to happen. But I simply want to be unbiased and objective on this channel. You have to understand markets and their external factors from an unbiased view. You can't let the emotions get in the way. You have to be real with yourself sometimes. And on a bright note, recessions can be very full of opportunity, especially if you're a young person, right? If markets tank, those are great buying opportunities. If things go out of business, you're able to start a business. So I don't want you guys to be too scared of the idea of a recession. If anything, it's very pivotal to the economic cycle. It's very healthy from time to time. And hopefully you've allocated extra cash, you're spending responsibly, you're sticking to your budget so you can be prepared if and when a recession hits. And guys, we're going to be covering this topic pretty extensively on the channel as it plays out. So make sure you subscribe, turn on the notification bell so you don't miss any of our market updates. You can hop into our Discord and chat it up with me at any time. And until the next video, I'll catch you guys in the Discord. Peace.